The Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well. I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water, and there have been a lot of OGs, original Bitcoiners that are selling above 100,000. But it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year.
According to Tom Lee, the recent pullback in markets, a 2 or 3% dip in the S&P or 5% slides in AI names, has made investors overly fearful. The cause, he explains, starts with liquidity. The government shutdown temporarily deprived the economy of money flow. The Treasury Department wasn't dispersing funds, and that contraction in liquidity made risk assets wobble. But in Lee's view, investors are anchored to the wrong emotions. Everyone has become so cautious, so convinced that the market has peaked, that their pessimism itself becomes the contrarian signal.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
People have gotten pretty bearish in the last couple of weeks because the government shutdown kind of has deprived the economy of money. And then the Treasury Department isn't dispersing funds, so their liquidity has shrunk. And it's caused stocks to actually wobble. And every time the S&P is down 2 or 3%, or AI stocks are down 5%, I think people get really cautious. I think, first of all, bullish sentiment is not even anchored properly. People become so hesitant. I think everybody thinks there's a top. Here's the thing. When everyone says there's a top, there cannot be a top. The top in the dot-com was because nobody thought stocks could ever fall. They actually thought we were entering like an era of continued prosperity. The second thing to keep in mind is that markets have been strong for the last 6 months. There is incredible demand for equities because people are really offsides. That's what you have to keep in mind. In April of this year, people thought we were facing Armageddon because of tariffs, and you had many economists proclaiming a recession, and that's how institutions traded. They were actually positioned for a massive bear. They can't fix that in 6 months. So we're now getting into year end where institutions, 80%, are trailing their benchmark this year. It's the worst performance for institutional fund managers in 30 years, and they have 10 weeks to fix it. They're going to be buying stocks. And finally, visibility for AI has not even been affected by the government shutdown or anything. So companies are going to start, as they think about 2026, start making announcements. So I think in the final months, I think one surprise is the AI trade's going to come back strong because it's wobbled. But the Fed is getting people scared because is the Fed going to suddenly hammer down on things? But keep in mind, inflation has been softening. So if they cut in December, they're confirming they're on an easing cycle. Now that meeting's not for a few weeks, but that would be really bullish for financials and small caps. And by the way, what's correlated to tech and financials and small caps? It's crypto. So I think you're going to have a massive crypto rally as well. I think people have dampened their expectations for Bitcoin partly because Bitcoin's been treading water, and there have been a lot of OGs, original Bitcoiners that are selling above 100,000. But it is still an underallocated asset class. So I think Bitcoin actually potentially can get to the high 100,000s, maybe even 200,000 by the end of the year. I think it's a big ask. But to me, what's more obvious is Ethereum can have a huge move into year end because Even Kathy Wood wrote about it. She thinks stable coins have been cannibalizing demand for Bitcoin, and gold and tokenized gold is cannibalizing demand for Bitcoin. But stable coins and tokenized gold run on smart contract blockchains like Ethereum, and Wall Street is building, and Larry Fink wants to tokenize everything on the blockchain. That means Ethereum is where people are starting to raise their growth expectations. And if you're raising your growth expectations, then your discount to the future is going up. So I think that there's a bigger move in Ethereum, and Mark Newton, our head of technical strategy, thinks we can be like 9 to 12,000 by January. I think that's about right. I think Ethereum, just 3,600 more than doubles between now and year end, or between now and January. The bull market bottomed in 2009, and even in 2014, 6 years later, or 5 years later, there were many people at JP Morgan that were still sitting in cash, and they were becoming desperate because they didn't know when to start getting into the market again. So it's highlighting two things, and I'm glad you brought it up. Number one, when you sell out of stocks, you've made one decision. Now you're forced to make another decision. Are you smart enough to re-enter at a better price? That's the reason you should never panic sell, because unless you're positive you'll make a tactical re-entry, you've now sat out a compounding. And as Josh Brown's chart shows, every crisis was always an opportunity, not a time to sell. But the second is, if you're in that position, you have to accept you've made a big mistake. And the minute you accept that, then the way you fix it is dollar cost average. So you now have to re-establish your position, but I wouldn't do 100%, and I would not be tempted to say, I'll wait for a correction. Do you know how many people are waiting for a correction? So I would not put 100% back into stocks, but dollar cost average means take 12 months and then do 1/8 or 1/12 or 10% every month, and then you're back into the market. And that way, if there is a dip, you can actually take advantage of that. I'd like to correct something that people have said, because I've been in markets, as you know, for 35 years.
Yep.
And I've never thought retail was wrong. I grew up at Smith Barney, which was what they call, quote, a wirehouse system. So there was a lot of retail investors. That was, their order flow was probably 50-50, institutional retail. In the 90s, retail was always right. So the reason is, I think retail, remember, I'm generalizing because there's a lot in retail. There's zero-day traders, and there's Robinhood, and then there's Schwab, and then there's high net worth. But the reality is, the person who's buying stocks because they have a long-term view of stocks is going to get this market right.
Fact.
There are more of those people in retail than in institutions, because the institutional investor has a monthly bogey they got to beat, and they're under pressure to beat their peers. So sometimes they forget that NVIDIA is just a long-term buy. They're trying to time the market. So I would say anyone who operates with a long-term view is the smart money, and that's been mostly, more of those folks are in retail.
Lee also draws a powerful distinction between conviction and stubbornness. Conviction means anchoring on sound fundamentals and data. Stubbornness means believing you're smarter than the market. And here's his reminder: in a room full of geniuses, the best you can be is average. No one is smarter than the collective intelligence of the market. The key is humility, letting price action and market signals guide your positioning instead of ego. That's how his firm, Fundstrat, operates.
I think there's something that I think is important, and we speak about a lot, which is there's a difference between having conviction and being stubborn. And being stubborn is like what you're saying. People believe that they're smarter than the stock market, whereas conviction is anchoring on the correct thing. By the way, remember, in a room of geniuses, the best you can be is average. So, like if someone thinks they're smarter than the stock market, they have to realize it is more than a genius. So we don't try to outsmart the market. Fundstrat lets the market tell us how to be positioned. I know it sounds backwards. I got to draw two circles. Okay. Circle one is all companies that trade at 100 PE or that don't make money. Okay.
Yep.
And that's like 40% of the 40% of the stock market. Like not in the S&P, but just like of the 4,000 stocks out there. Of course, the majority are bad investments because, if a company can't make money, it's probably not worth your capital to risk. But then I want to draw a second circle. Unique, what they call N=1 businesses, okay? What are N=1? Companies that, number one, are like laying the groundwork for a huge secular story, therefore they're not making money now. Or founders that are creating constantly new markets so that the current earning stream doesn't reflect the future. Okay, Tesla and Palantir are examples.
Yep.
Look at data centers. I did wireless. Wireless was exactly that second category. They didn't make money because they were building cellular systems, but once they did, they became like huge companies.
Yep.
They should trade at huge multiples because you're trying to discount the future. Imagine if someone said, I'll only pay 10 times Tesla earnings because it's just a car company. They missed it for the last almost 8 years. So that category, you have to start with a different mindset, which is find unique founder-led businesses and then determine if the multiple is reflecting the discount to the future. So those cases, I think you can pay 100 times. But the other circle, all companies that don't make money and trade 100 times, 99%, of course, are not great businesses. AI is a scale business, meaning you got to have a lot of money. Like you and I can't make a competitor to OpenAI. Like us in our garage. Like we'll make something that looks cool, but it's never going to compete with OpenAI. So it's a scale business. A scale industry is something like energy or banking. There are only 8 oil companies in the world. Literally all the capex for all the refiners. Like there's only 8 people that buy oil in the world. What if someone said oil's a circular business because there's only 8 companies buying oil? Like we'd say that's ludicrous because you got to be big to be drilling for oil and you got to be a major. Guess what? That's AI. It's a scale business. That's what this is showing. And do we want NVIDIA to be dealing with like hundreds of thousands of tiny little companies? I'd rather they be dealing with some big companies that can deliver stuff, and then there's ramifications, and then to ensure the financial viability. So I think it makes sense that there's this taking place. I think it's really logical. Yes, that's right. Geopolitics can crash unstable economies. I mean, it makes sense. Like, if you're looked at like Asia, anytime there's been like a revolution, like the stock market crashes. And I think a lot of people think the United States is a banana republic, but as you know, the real key is, are companies' earnings going to crash because of geopolitical tensions? And if they don't, then I think we should stop, like you said, overlaying that as a principal reason we can have a bear market.
Lee touches on geopolitics. Yes, political instability can crush fragile economies. We've seen it in Asia and emerging markets during revolutions and regime shifts. But the U.S. is not a banana republic. What matters most isn't political noise, it's whether corporate earnings are collapsing. If profits remain stable, then geopolitical tension alone isn't enough to justify a bear market. Investors should separate headlines from fundamentals. Lee also draws a powerful distinction between conviction and stubbornness. Conviction means anchoring on sound fundamentals and data. Stubbornness means believing you're smarter than the market. And here's his reminder: in a room full of geniuses, the best you can be is average.